Well, here's Edmund Shing, joins me in the studio now. Edmund, given the number of meetings that we've had over the past few weeks, got another big one coming up on the 9th of December, the mixed messages, the reports, and then the denials of there being any aid coming from the IMF for Italy. I mean, this is a remarkably optimistic scenario you have here.
Well, I think yes and no, because I do think, on the other hand, that people are very pessimistic, and I think investors have been right to be pessimistic and probably are still right to be pessimistic, simply if you look at the history of this whole crisis. If you throw ourselves back to 1 year ago, we had a great opportunity within the Eurozone to nip this in the bud, sort out Greek financing, and we would have avoided all of this trouble. But of course, Angela Merkel couldn't bring herself to back that solution, and here we are in a much deeper, more expensive mess. And so investors are saying, yes, there is just all this huge volatility. Politicians have singularly failed to avoid it up to now. Why should this be any different this time?
Could then answer your own question. What gives you reason to be so optimistic? Why should it be any different?
Well, I think firstly, we have had some serious moves by Germany. So I think Angela Merkel has subtly shifted her position little by little, but it is quite clear now that she is willing to give and take. So clearly she's asking for greater fiscal harmony within the Eurozone, and also more political unity as well. So things like qualified voting, for instance, instead of getting rid of the veto amongst the 27 EU states. However, Germany has to give something back in return, and I think that something will be greater funding and greater participation to bailouts for the other countries.
I mean, we've seen a very mixed reaction on the markets today after the big gains that we saw yesterday, the sudden rise in risk appetite as we saw central banks around the world join forces to really boost liquidity in the system, to provide cheaper liquidity support for the banks, if you like. Does this give you much confidence, or do you think it's a short-term solution, as Governor Mervyn King has been alluding to?
Yeah, I think that I don't think it's any sort of solution. I think what it tells you is the liquidity crisis was extreme for European banks, and certainly this helps that very short-term crisis issue. However, the real issue is much more about government solvency longer term, and about the ability for banks to fund themselves longer term. And of course, then the June the 12th European Banking Authority Tier 1 ratio test looms large, and that's really what we have to be worrying about. And I think that's a serious risk for the European economy. If there's one downside risk, it is a credit crunch, and Mervyn King was very right to allude to that. That is the key risk for us.
So, I mean, when we look at the banks and stresses in the funding markets, and then pressures that they're expected to face as a result of regulation and European exposure to European sovereign debt, I'm just wondering, are you investing in banks right now, or do you see them as being rather untouchable?
I think not just myself, but I think investors in general regard them as being pretty untouchable within Europe, simply because the level of volatility and the level of regulatory uncertainty remains so high, and funding uncertainty. Will they be able to roll over their bonds? We just don't know.
Edmund, I have to say, given you're concerned about fundamental issues of just a lack of fiscal integration in Europe and a lack of budgetary discipline, if you like. At the same time, you're saying that you expect the EFSF to guarantee new Spanish and Italian bond issuances.
Yes.
Why should that give investors any confidence? European finance ministers, they agreed this at their recent meeting. They talked about, a 30% guarantee for bond issuances. But, given the deeper liquidity and solvency issues that you describe, why is that going to give them any more confidence?
I think by itself, it's not sufficient. I think you have to have the two approaches. You need to deal with the liquidity issue and the solvency issue now, and the EFSF can certainly help with their partial guarantee. But at the same time, the governments must clearly continue to do their part in terms of implementing more austerity measures to reduce budget deficits today, and to implement structural reforms to boost growth rates longer term, because that's the only way out of the hole.
Very interesting outlook you have for 2012, Edmund. Let's just run through it, because you don't expect to see much of a change in the macro picture overall. You warn of a possible credit crunch here in Europe as bank headwinds translate into reduced lending. But one area you have singled out as having momentum is the US. Interestingly, you're saying that it's going to outperform next year. Now, of course, they're facing big budgetary debt challenges as well. Does this mean that you think we will see some sort of agreement at some point in terms of bringing public finances into greater order between Democrats and Republicans?
Yes, I think the failure of what's interesting about the US is the failure of the US Super Committee has been blamed more by the US people, the US public, on the Republicans than the ruling Democratic Party. So it's not President Obama who's being blamed. It's actually Republicans being blamed for being intransigent. And I think that then puts pressure on them to move a little bit more towards President Obama's position in the next few weeks and to agree a limited set of measures to reduce the level of fiscal drag that we otherwise would face in the first quarter of next year.
Edmund Shing, Head of European Equity Strategy at Barclays Capital, thank you.
Thank you.